Well, this week is finally over. It was quite the week, especially for the U.S. dollar. When you consider the North Korean summit at the beginning of the week, the Chinese tariffs at the end, European Central Bank meeting, Bank of Japan meeting, the Fed, the FOMC meeting, inflation data, economic data, all over the board. I'm going to break down how that impacted our market posture and what to expect next week now. And I'm also going to take a look at a trade in an area that's been relatively underperforming, not looking so good, but in a stock that's been the weakest performer in that area that now might be showing opportunity for a good trend trade going forward. I'm going to show you what that is. Let's go ahead and get started. Today is Friday, June the 15th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks for tuning in. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by by mousing over the Market Scholars logo in the bottom right corner of your screen. Click that red subscribe button that pops out there. Like tonight's video by clicking the thumbs up icon down below, and comment on anything that stands out to you from tonight's Market Outlook. Join our daily Market Outlook email list with that link popping up in the top right corner of your screen. Click that link and subscribe. Follow me on Twitter for more content like this throughout the day, throughout the week, and join our Market Outlook community on Facebook. All right, well, let's take a look at how the week ended up with the market forecast tool here on the S&P 500. You can see we finally pulled back today on the tariff news. I mean, it took tariff news and a trade war to get us to the 23% Fibonacci retracement level of the prior near-term run. So, I mean, yeah, this is the pullback we've been talking about getting. And you can see, I mean, at the lows of the day, we were actually pretty bearish. I mean, not like trend-changing bearish, because even though the short-term sentiment was extreme to the downside, the intermediate line is still well in the reversal zone. So it's not like we're changing this bullish trend anytime soon. And of course, I mean, we're not even like, you worry about the next bounce not getting to new highs when you go past the 50% retracement. And I mean, we were just sniffing the 23% retracement at the lows of the day today, at the worst of the day. We weren't even getting close to the 38%, which is like kind of like the sweet spot. So you know, grain of salt on this, you know, 2 out of 3 day pullback that we've had, or really 3-day pullback from the high point that we had on Tuesday. You know, the momentum line did drop to an extreme low point. That's typically a red flag. But again, grain of salt, because of we haven't been bullish for too long, and the market sentiment just barely crossed above 50, now up to 57. So it's rising pretty fast. Excuse me. The near-term line, you know, was down in the reversal zone earlier today. Finished not only out of the reversal zone, but finished back up above 50 because of the bounce off the low. So that just shows how bullish the late end of day rally was for stocks, producing a new near-term low point with the near-term line getting below 50, but not below 20. Obviously higher and hitting that 23. It's not, I mean, ideally you'd like to get to that 38%. Ideally you want to rise up and pull back and rise up and pull back. And, and I mentioned earlier in the week that, you know, the odds are we'll probably just kind of mess around within that, you know, range there. And that's pretty much what we've done all week long. We haven't, you know, yeah, we've had a little bit of a pullback, but it was about as sideways of a bearish pullback, short-term bearish pullback as you could possibly get. It wasn't really that big of an issue. Now, traditionally, seasonally, from after June expiration, there is a little bit of weakness into the end of the month, and then at the beginning of July, we get a rally up to new highs at July expiration, and that's July expiration is when, you know, the whole sell in May and go away thing. It's really sell at July expiration, and then come back before October expiration. That's where the seasonally, over the last 20 years at least, stocks peak and then bottom out within that sell in May and go away time frame. And so, you know, seasonally, you would expect, now that expiration's done, some weakness. But from terms of, you know, again, not taking into account seasonality, but just looking at the chart, we've got the short-term weakness we were expecting, and now we kind of, and it's at that resistance. Now we kind of expect a new near-term bounce and to get up to that 2850 area. Now, whether that will occur or not, who knows? But that's the expectations because of the near-term highs and lows that you continue to get, and the fact that the intermediate line is entrenched in the upper reversal zone, which means that you got a strong bullish posture, and market sentiment line is rising, which means the path of least resistance is to the upside. I mean, look at this week and look at the end of the week, and as bearish as that news could have been, including a rate hike on Wednesday, as bearish as all that could have been for stocks, that was the end result, a sideways little tiny pullback to where we fell from 2786 on Tuesday to close at 2779, so 6 whopping points in the S&P 500 with all that bearish news. Again, that's what happens when path of least resistance for stocks is to the upside. The path of most resistance is to the downside, and you can see how hard it is for it to go down. You look at the Dow Jones Industrial Average, it did pull back a little bit more. Its near-term line did get into the reversal zone. Its intermediate posture, though, still is strongly bullish, and it would be an easily higher low point that you're getting here. You can see where the Fibonacci's are. And here, let me just draw this here. Wish that was default, but you can see, we did get to the 38% and a little bit through the 38% on a intraday basis, but still not quite closing below it or below those highs there, that old high point. So, typical, pullback on the Dow. The NASDAQ composite, man, it did not pull back at all, and this near-term line is now back in the reversal zone. So, again, it's hard to be too bearish with that pattern. And then the Russell 2000, you can see, has been the most bullish of all today. It rallied sharp. In fact, it produced an overbought cluster today. It's kind of hard to be too bearish on a day when you got an overbought cluster on the Russell 2000. Remember, the Russell 2000 and NASDAQ had been kind of, they've been outperforming, but then starting to lag a little bit, and you can see kind of regaining that leadership, and that's good. That's what you want from a bullish market perspective. You want those, kind of more higher beta, more aggressive areas to lead the way higher. Eventually, S&P and Dow will lead as the market gets more mature. The intermediate posture gets more mature, but now that we're just a month into it, this is a very good sign. Again, I wouldn't read a whole lot into that overbought cluster as a reversal signal. It's a sign of just how strongly bullish we are right now. All right, before we look at the other charts, a reminder on the blog here, there's a link to our Market Outlook forum on the website right above the video. And right below the video, some information on our discount offer, our early access, kind of beta period discounted offer. There's a link right here, and then there's an email address from about over 40 current market scholars and what value they've gotten out of being a member of the site so far. So check that email out. And of course, one thing we always ask with all these videos is that you give us a like. That's our feedback. That lets us know that you got something out of the video. You want us to keep doing the videos. And we've noticed that the likes have actually dropped off a little bit here on Twitter. And then, of course, on Facebook right here where the thumbs up is and this green button. So, that's something we ask of you guys. If you want us to keep doing these videos the way you tell us, and you can do it while you're watching the video here. Just scroll down while you're watching. 3 clicks. One right here for those who have a Twitter account. If you also have a Facebook account, you can click right there with the thumbs up, and of course the third one right there. And if you haven't joined our daily Market Outlook email list, there's a form to do so below that. All right, looking at the long-term chart here again, this week has been the most bearish week that we've had over the past 3, and you can kind of see that as bearish as this past 3-4 days have been. That's what it looks like on the weekly chart. So we're still elevated above a rising 50-day moving average. We're pretty decently away. I mean, we never really got that far away before here without pullback. So. But we are, trending higher. The 200 days trending higher. The 50 is rising above the 200 day. This is a pretty high level as it stands. This is a relatively high level compared to where we've been in the past, and it's still rising. So from a long-term standpoint, we're still, all signs point to the upside. You take a look at the 3 green arrows chart. still have 3 green arrows, because even the MACD didn't give a red arrow yet today. So we're above a rising moving average. You have positive momentum. You look at the MACD lines. We're just still above the moving average. Stochastic's a little bit below, but it's still above 80, and we're still after today's close still above the 8-day moving average. So again, now we did get a little bit below it on the intraday basis. We didn't get below the 17-day, and that's when we're still obviously well above the 30. So that puts into context that the bullishness that we have, and this is the type of pullbacks you get again when market sentiment line is rising. The path of least resistance is to the upside, and the path of most resistance is to the downside. Now, out of all the charts here, this one probably looks the most bearish as it can be, in terms of, we did gap down today. Keep in mind the dividend, the ex-dividend date, and the impact that can have, which obviously does on a stock like this. You look at SPX, and you can see, there was a decline, but not nearly as big as it was on SPY. And again, you can see, so after the dividend, yes, we fell. The low of the day was early, but then we rose throughout the rest of the day and finished above the high of the day there, and obviously still staying easily within the upper half of the chart. And again, looking at the cash index, which does not have the impact of the dividend payment, the cash index got back up above yesterday's low point. So we finished higher than the low and easily in the upper half of the chart still. And again, if I were to draw the Fibonacci lines on this chart and try to again snap them to the open, high, low, and close, you can see that again, there's your 38% Fibonacci retracement. We'll draw on the 23% line, and that's where we got to. And there is some old lows in this area, and that's what we touched, and we'll see if that ends up being it. Now, a little bit of a head and shoulders potential pattern developing there, but again, the trend's bullish, and we're still just a month more. It's about a month and a half into it, so there's still expectations for more based on this typical time frame. So this may be our near-term pullback that we look for and we bounce off of and start a new 7 to 12 day run. Obviously, you can see the range was a little bit below average there, and then you look at like the volume for today, and you see that today's volume was more than 1.5 times the average, quadruple witching. A lot of activity today, obviously the tariffs, but look at most of today's volume, according to that chart, as buying volume. So you look at the the volume here picking up a little bit, 1.5 times the average volume. We'll see if that ends up setting the low point on the near-term basis when we bounce off of that. You can also see too the range today, remember, was just a little bit below the average, and the average compared to the current price is now obviously well below 1% and trending lower, even if it bounced up a little bit, trending lower here, and that continues to be a bullish pattern for stocks. And of course, volatility bouncing up early, up to 13 before finishing the week and the day back below 12 and back easily below 85%. So, and maintaining a bullish stance on volatility as well. So to summarize, we were looking for a short-term pullback into the end of this week. We got that pullback, even if it wasn't 38% retracement, and a nice, pretty retracement. But when we have so many bullish signs and bullish charts, and the path of least resistance is the upside, this is kind of what it looks like. And we'll see if next week, seasonally, isn't typically a bullish period, but considering the current environment we're in, that is the expectation that we'll have a nice bounce back up next week. Probably not as big, but still pointed to the upside as we finish out in potentially a 2 to 3 month intermediate run that we're now a month and a half into, as we head towards that July 15th, the July expiration, which is typically the bullish peak of the summer before vacations come in and people take the end of the summer off before school starts and get back to work, and so that's the seasonality aspect of things. So That's the expectations. What do you think? Do you agree with that? Disagree? Let me know with the poll. It's popping up in the top right corner. Let's see if we can get 100 votes. So if you're watching and you're listening, I want to see what you think. Agree or disagree. If you disagree, comment down below and let me know what you're seeing here. That might give you a little bit of a different opinion. All right, now let's take a look at how the different asset classes performed today and what's driving the market. Of course, the biggest news out of all what's going on was the tariffs, the trade tariffs that were announced last night. It almost looked like the dollar was up today. When you look at what was the worst performers, what was the biggest performers? Crude oil was down 3.5%. Gold was down 1.75%. Emerging markets started the day bearish. Of course, China being the biggest emerging market there. You can see China started the day down quite a bit before rallying. Russia started, was down 9% here, and you can see some of these others that have been more kind of impacted by tariffs. Canada, Japan kind of falling in sympathy with China. So those are all the, how the markets overall globally are reacting. But again, like I said, it looked like the dollar was up today when you look at these three things being down, and the dollar wasn't up today. Now it was up yesterday, and it continued. It seems like the markets kind of continued, that theme going forward. And with the risk off early, you see bonds were up. In fact, bonds were the only thing that finished up, but not completely risk off. When you see that small caps outpaced large cap stocks here, and that's a pretty decent. That's a good sign. Of course, the stocks in the S&P 500 would be more impacted by those tariffs than the stocks in the Russell 2000 would be, and that's why you have the outperformance there. But still a good sign to see small caps, finishing the day off their lows and with pretty flat. The S&P 500, of course, also finishing off its lows. But when I go out to the week now and look at how things performed over the course of the week, the dollar finished the week because of today's loss in crude. The dollar finished the week as the best performing asset class. And small cap stocks finished the week with a small gain. Large cap stocks were down just a little bit, and of course a lot of that's dividend related. If I were to look at the cash index instead, here you can see not as down nearly as much. There we go. You can see, well, here, let's go to right there. There we go. You can see that pretty flat by the end of the week for the S&P 500 when you don't account for that dividend. Of course, there's the Russell 2000 with a three-quarter point gain. Bonds up on the week too, so you typically don't see those two things together, long-term bonds and small cap stocks. But those are the two biggest performers. Of course, the dollar finishing strongly after the FOMC meeting. Big bounce up early here, pull but knee-jerk reaction to the downside, and then rallying. And of course, emerging markets were the biggest losers with that dollar strength. Gold and emerging markets are the two asset classes that struggle the most. And of course, a lot of that dollar strength comes from weakness in the euro. Yesterday, the eurozone showing the European Central Bank showing some dovish remarks, talking about the idea that they would start slowing down. They would halt their quantitative easing program. But they would still keep interest rates low, going through to next summer. So at the end of the day, a dovish market reaction to that, and that's what propped the dollar up. There's the weakness in the euro. Now the question is, and you can see it halted today, that selling stopped today. We're going to get through this 115 area, and which has been a support here in the past. Last time we hit 115, we rallied up to 126 almost. So are we going to do that again here at this 115 level, which you can see from a Fibonacci standpoint? Let me zoom out a little bit further. So you can see that this Fibonacci retracement zone comes from the rally that we've had since April of 2017 in the euro, from 105 all the way up to 125. So 2,000 pip move, that's a tremendous move over the course of a year almost, but a pretty decent move. Now we've had the retracement. Breaking 115 would be significant. As you can see, that's where some old highs were. that would be significant for the single currency, and that would be very bullish for the dollar. Holding the support though and making a move up, you can see when the euro made its move from the end of October up through the end of January. If I were to take a look at the dollar during that same time frame, end of October here, right about in this area. Oops, there we go. End of October, so right there, that's the end of October, and then by the end of January here, that's what happened to the dollar during that run. So, and the dollar's also kind of at a resistance level similar to where the euro's at. Again, a break below support on the euro, that'd be bullish for the dollar. And right now, it's not a pro-dollar market. It's a very weak euro market that's propping up the dollar, as those two tend to be an either-or type trade, the two biggest currencies out there. So that's worth monitoring from the euro side of things because of how it impacts the dollar, and of course the impacts of the dollar and how that impacts these asset classes here. You can see the dollar really took off after hitting this low point in 4/16 of 2018. If I were to zoom out here and look at how the markets have performed since 4/16 2018 right there. So there's the strength in the dollar. You can see, again, small cap stocks have been bullish and doubling what the S&P 500 has during that period that the dollar's been so strong. But look at what has not been so strong. Gold is down 5% during that same time frame. Emerging markets are down 5% during that same time frame. Even developed markets were down more than 1%. And then, of course, you can see crude oil also, starting off pretty strong. But again, it's these two, dollar and crude oil, typically don't move hand in hand. And so eventually it was crude oil that gave way and the dollar maintained strength while U.S. stocks have outpaced. So that's what's happened when the dollar has been strong. If the dollar starts to pull back, we can expect the opposite of this to the upside and things to reverse. Not that stocks have to drop down, though this might not outpace these international stock markets like they have been. And you might start to see, in fact, you could still continue to see small cap stocks lead the way, but you also might have some outperformance in large cap stocks as the current intermediate posture matures. We can do the same analysis here on the U.S. sector. So again, from 4/16 on till now, what sectors have done well during this bout of U.S. dollar strength, and it's consumer discretionary technology. Those tend to do well when the dollar strengthens. Materials and energy will lag, and up until remember the crude oil had a good run, and eventually with crude oil weakness, energy stocks ended up lagging, pulling down here, especially here lately. And materials have been lagging too, and industrials have been lagging with the strong dollar. So you'd expect those to lag during a strong dollar. They're still up, they're just lagging the broad market. Whereas you can see utilities and consumer staples have been the worst performers. But consumer staples now, during this little run that we've had off of this near-term low point over here for the S&P 500, and even through this little pullback, you can see staples are starting to make a little bit of a run. In fact, all consumer stocks, as well as healthcare, continuing to outperform too. And if you look at this chart, you can see, some red dots. We got a red dot here in telecom. We got a red dot in staples, and there's the overbought signal you got in staples. So a good sign for staples. This doesn't necessarily mean a rollover, even though it might produce some short-term weakness. But what it does is establishes the trend. Now that again, those red dots mean just how strongly bullish we are. Establishes the trend there. You can see discretionary technology and healthcare all still maintaining intermediate postures, strong intermediate postures, and well above rising moving averages. Real estate starting to pull back, and energy you can see breaking down. So a little bit of weakness in energy sector, something we talked about in our portfolio management with ETFs class yesterday, of how we want to tilt in our sector rotation there, and that was part of our discussion. The energy sector was part of our discussion there. You can see materials also pulling back, strong dollar impacting these. The question is, will it continue to impact them? You can see industrials also these three areas right here are all very economic growth sensitive areas, all showing some pullbacks. We'll get new GDP estimates next week, so we'll see if they start to pull back too. But as of right now, that might just be pullbacks, because economic growth estimates for that second quarter this year are up about 4.6, 4.8%. So very, very strong figures. So you might start to see some of these outperform again if the euro is able to hold the support and bounce and the dollar starts to show some weakness again. You'll start to see some outperformance back in these areas, and energy especially has some room to outperform. It's got a bearish posture right now. There's not very many bearish postures. Financial has a bearish posture. Energy and real estate are all bearish. Not as strong because they're all still above 50, but they're all bearish there. And everything else, even staples, above 90, above 90, above 90, above 90, all those are very strong. Industrials maintaining a bullish posture even though it's falling, and materials same thing. One stock in particular that has been showing some renewed strength here and a good pattern this week is Dominion Energy in that utility sector. Look at all the oversold clusters it's gotten, including one here last week, before bouncing up this week and bringing that market forecast intermediate line above 50 for the first time since this bullish run that we had in November. So a dark green shaded area finally. You just don't see that very often on this stock. Finally rising. Market sentiment's very low, so there's opportunity for this to make a run. Last time, to give you some context here, last time market sentiment line was in that reversal zone and came out of it. Here we go. I had to get rid of the charts to the other line so you can see. The last time we've been market sentiment has been this low for this long. I mean, look, I have to go way, way back. I mean, a little bit in 06, and you can see the run that it had there. But to go even further, you have to go all the way back here at the beginning of 1999 when we've had that bearish of a move, and you can't really see with the charts kind of scrunched up there. You can't really see the move that it had, but essentially going from 19 making a run by the end of the year up to about $24 for utility stock. Pretty decent run. And so, again, there's opportunity here. Now, whether it's going to, go up 50%, or 20 or even 30%, you can see where we just were at the end of last year and the sharp decline that we've had to get to a level on market sentiment that we just don't ever get to on this stock during its pullback. So, in other words, there's opportunity here. If you take a look at some of the other charts, like the 3 green arrow chart, you do have 3 green arrows and a spike in volume, especially today. You look at the Bollinger Bands getting outside the upper Bollinger Band here, starting to make a run from the lower bands when we were down below, getting through earlier this week through the middle band, so kind of a breakout move, and then today getting up through the upper band. So positive development for the stock in that regard. You can see the DMI for Dominion getting above 25, the positive line getting above 25 for the first time in a long time as well. Again, since this bullish run, when you had that little rally here, that when it broke above 25, you stayed up there for a while, and ADX rose. And then, of course, you look at that long-term chart of the 50 and 200-day moving averages, and very, very, very bearish. And again, you have to kind of go back as far as you possibly can on this to see how bearish that is. There's that 09 period where the MACD and stochastics dropped, and again, you remember the momentum, the market sentiment didn't get down that low. This is on a weekly chart, mind you. But this is the last time it got that low, and look at the run we had coming off that low. Well, we're even lower now, and when you are this far, you might get some false signals up above that 50-day moving average. So if I go back over here, right here, let's see, was that it? No, right here. If I look in there, you can see, you get this far away from the 50-day moving average, and you can see a little how you can kind of get some false signals here before you finally break and it starts to rise, right there. You finally get, you get a little bit of a break there, and then boom, and you get a little bit of a break there, and you finally get going. Well, here you can say, well, could we get another false signal? And the answer is definitely yes. So we are breaking above the highs of the past 4 weeks, 5 weeks this week. and getting above that 50-day moving average. In other words, there's a good opportunity for a trend trade on this stock because of how beaten up it's been and how much opportunity, especially if we rotate into safe haven areas, and especially if yields, at least for the time being, peak and start to aren't able to continue to make a run. You can see the 10-year yield down a little bit today, and looks like it's hitting some resistance right now at 3%. So we'll see if it pulls back down to 2.6%, after hitting this resistance, which any kind of move like that would be beneficial for a utility company, especially the one that's been beaten up the most. So like we talked about in the previous market outlook on the trade on HOG, HOG, Harley-Davidson, we looked at a trend trade which you could easily buy the stock or a long call, whichever one. Same thing with Dominion. I prefer in this case, because of the dividends, to be able to buy the stock and get those dividend payments if you end up holding this for a quarter or longer to get that little extra return. That being said, thanks as always for joining tonight. Let me know in the forums. There's a link popping out in the top right corner. Click on that link, go over to the forums. Let me know what you think about tonight's trade. Comments, questions, something you agree or disagree with, post those in the forums. Thanks again for watching tonight. I appreciate the time that you dedicate and spend watching these videos night in and night out. Please let us know that you liked it and that you want us to keep doing it with those 3 easy clicks. Liking the tweet, liking the Facebook post, liking it on our blog. Again, subscribe to our YouTube channel, like the video there, comment on anything that stands out to you, follow on Twitter, and join our Facebook community. Have a great weekend, everybody. We'll see you all next time.